All right, Matt, you want to do the intro today?
Yeah, sure. So you are in a different location. I'm guessing that's because you had to sell your house because the markets are down and everything is gone to hell in a handbasket. Is that accurate, Bradford?
Yeah, I'm living in the the housing that they give the people.
If
No,
we're
I'm on spring break in Chicago and shortened spring break, but I've been working the whole time.
Yeah, we have been deep in the weeds of our internal software, doing some rebalancing. So if we are a little bit less fine-tuned than
Coherent.
usual, it's because we have been deep in the weeds of a lot of tedious trading and rebalancing type of stuff for the last couple of days. So, but nonetheless, we've got a lot to talk about. Obviously, lots of volatility in the markets. Tesla was at one point up 7% today. I think ended the day down around 3% or so. Very wide range there, obviously. S&P, NASDAQ, major indices were all up 2% to start the day, ended the day down around 2%. So we were expecting VIX would have to come down at some point. Volatility would be coming down. I guess not yet. So
Definitely
lots to get
not
into.
intraday vol. Yeah.
Intraday vol has been kind of wild. I mean, yesterday we had this, rumor of a trade deal being reached with the EU, and so Tesla shot up some crazy amount. I think I shot up to 250 and then went back down to 230 in a matter of minutes. Markets are clearly spooked right now. So the question on everyone's mind is, where do we go from here? And so without doing a whole intro on all the different topics we're going to talk about, I think the thing on everyone's mind is, how real is this? Is there going to be lasting economic damage that takes a lot of time to pan out? And maybe we slide into a pretty serious recession, and we have supply chain shocks potentially if companies aren't able to get parts in. And there's that whole scenario, which I think is a very real possibility. I'm trying to figure out what probability I think is that scenario. Or is this all a negotiating tactic, and Trump will fold? Or is it something in the middle where, we're going to have some maybe more nuanced version of what we've seen so far with the tariff policies? Bradford, what's your take on the maybe three different broad outlines that I just painted?
And I'm going to share some strong opinions. So I'm not going to give you one of those Wall Street analysts where it's, $10. It could be a $10 price target or a $500 price target. Also, we're going to share some of the recent moves we've made. Not everything, but some of the recent stuff. So I think we entered a recession as soon as Trump came out with his announcement. And the reason why is that there's a number of business leaders that didn't vote for Trump, and people who didn't vote for him were apoplectic with the chart that he unveiled. And they definitely don't agree with the approach that Trump is taking, and they think it's very bad for trade and for the country. And so I think those people have pushed a pause button on their business growth. Stop capital spending. Maybe there's some things that may not pertain to trade, but if you're involved with trade and making stuff, and you do have some parts coming from different parts of the world, I think there's people who just straight up panicked and hit the pause button. And there's going to be some economic consequences from this. So first one is, I think we entered a recession Wednesday night, and I don't think those people who feel that way have had enough to hit the play button. So let's just stick right there. What are your thoughts on that, Matt?
Well, so the first pushback I'd have on that is, I think it's not just people that didn't vote for Trump that didn't like his presentation
That's
on
true.
Wednesday. I mean, Elon has been, I would say, in a very measured way, providing some pushback. We obviously saw that with Bill Ackman and others, and I mean, I've been, I think, mildly positive on a lot of the stuff that Trump is doing, but I came out with a post basically saying that was just dumb. I think it's fair to say that they actually lied about what that chart said. I mean, they called it tariff and non-tariff barriers, but it was actually just imports divided by total trade. Like that, I think is just extremely misleading, and I think it loses the administration credibility when they're saying it's one thing and it is just in fact something else completely. If you want to go down that route, that's fine, but I thought the whole tenor of it, like saying these other countries have been taking advantage of the good American worker, and like even using words like raping, the American, it's just like so over the top. And I could put myself in the shoes of a Canadian or a European or a Chinese, that is just like, we're just like working hard, and that was the old system, and all of a sudden, like I'm being accused of like raping the American worker. It's like, come on. So, part of me says, all right, that's just Trump. He says crazy things all the time. I shouldn't, get too fixated on the words that he uses, because he's not a fabulous linguist by any stretch. But I just thought that the tenor of it, coupled with the content of it, it just seemed very. It didn't seem very well thought out. And for something that he's been talking about as like a cornerstone of his policy for a long time, I just thought it'd be a bit more nuanced. So then I think I'm in this camp of wondering, all right, well, is this just a negotiating tactic to get to some better outcome, or does he really fully intend to kind of go down this road and be a bit more isolationist than I think even his supporters were expecting? So that's the question I have in my mind right now.
So I think I'm going to be a little strong here. I'm going to say what's on my mind. I think they're in a win-win scenario with this. It's definitely a dangerous thing because it hasn't been done for a very long time. And the reason I think it's a win-win is like, okay, if you get negotiations and you get a deal, then that's great for everyone involved, and it's great. Good for America moving forward. And if you don't get a deal, then you get the tariff revenue. So I think that's where the win-win is. Yeah, they can't. I'd say like the hard part is like they gave a week for it to go into effect or whatever, and they didn't have time to like have a full negotiation with any single country. Maybe they fully negotiated with Benjamin Netanyahu of Israel, and maybe that's a done deal now. And maybe there's a couple others that are done deals, but they're kind of waiting a little bit to, I don't know, put pressure on or anything. So I'm more of an optimist. I think we should give a few weeks for this to play out, see what happens from here. And I believe that the pressure on the other countries is actually higher than the pressure on the United States. Now, certainly there's a difference with China, where they own a lot of our debt. They buy a lot of our debt and assets, which in a way it's good that they buy our debt, but like they're buying our assets. So like we're buying electronics and other stuff from them, and eventually we throw it away. But in trade for that, they're getting farmland. They're getting other things from us. They're getting U.S. dollars, cold hard cash. So I'm a supporter of like playing this out, but I do understand why people are panicky about this.
Yeah, we were looking
fear
at
is
this.
Very high.
Yeah, I was going to say, we were looking at this yesterday, and we were figuring out, okay, like, tariffs, China's obviously exporting a lot more to us than we are exporting to China. So, that would seem to suggest that we've got a lot more negotiating power in this. We did some kind of quick math, and I think we were coming up with something just under 3% of China's GDP is exports to the U.S. And I think for the other way around, U.S. exports to China as a percentage of U.S. GDP, it was like 0.5, 0.6%, somewhere in that neighborhood. So certainly a trade war that has tariffs would hurt Chinese exporters a lot more than it would hurt U.S. exporters. but it would also hurt American consumers, in the form of inflation and or just lower access to some goods that that they may want. So I think it is complicated, but I think in that sense, it probably does put a little bit more pressure on the Chinese government to make a deal.
A little evidence for that is they allegedly announced an emergency economic stimulus. They didn't call it emergency, but China is being forced to stimulate their economy as a result.
Yeah, and so that was I think kind of my thinking. But Kimball Musk, right before we got on, had a really great post actually, which I'll actually read just because it's for anyone who's listening, It might be a little hard. But he says the only way to apply sense to Trump's trade war is to create massive uncertainty that will force the Fed to lower rates when we need to refinance 6.5 trillion of treasuries by June. China knows this, and by selling treasuries, they create counter pressure for the Fed to keep rates high. This game only needs to be played by China for 2 months until end of May when we need to refinance our debt. Also remember that China is not a democracy and doesn't have free speech. They can control messaging in their country while Trump cannot control it in America. So Trump is playing chicken with the Fed. China knows this and is selling treasuries to try to make Trump lose the Fed chicken game and gets trounced by public opinion. The Fed is run by patriots and will do what they can for America, but they are subject to market pressures just like everyone else. So I thought that was actually a pretty good counterpoint to the thesis that I think we've been developing, where China has a little bit more pressure than the U.S. to make a deal. They certainly have some pretty significant leverage in this game too. And my fear in all this is just that this whole thing is a lose-lose, and so then I think we're, assessing the probabilities of these various scenarios. Do we make a deal? Is there some off-road or off-ramp to some widespread economic damage? I would guess there is. I don't know what that looks like. But if I had to bet on what happens here, I would imagine that a week, 2 weeks, a month down the road, we see some sort of revised version of those tables. Maybe it's even country by country where, there's just a series of deals announced where, maybe there are higher tariffs that were in place than were in place before, but there actually is some true level of reciprocity where the tariff and non-trade tariff barriers are roughly equivalent between all nations. I would imagine there's maybe some slight wins you can show, like some new plant got opened up in the U.S. and some. I don't know, Malaysia opens up soybean exports or something, whatever the, the issue is that Trump can point to having some big win, do a little celebration in the Oval Office. And that's the off ramp. Obviously I'm kind of hoping for a scenario like that, but I also think what are we down? I haven't even checked recently what we're down total on the indices, but 15% ish, somewhere in that neighborhood, I think. Since all this insanity started. So I think Trump doesn't want to, and you're muted, Bradford. My sense is Trump doesn't want to, he probably has a decent appetite for pain and volatility in the stock market for a little bit, but I don't think he wants to go down in history as being the guy who's, sank the economy. And 2 years later, we're still in this malaise and markets are still down. So I guess what's your thought? Is this an overreaction by the market? Or is it about right, given how much uncertainty and risk of true economic calamity there is?
I think a lot of the people selling didn't vote for Trump. So I think it's been political in nature, but also I understand why people are anxious, and just fear is extremely high. The fear and greed index at CNN's near 1 out of 100. So 1 is the most fearful, 100 is the most bullish or greedy. So fear is extremely high. You had hedge funds get margin called on Thursday and Friday. So
there's a lot of that.
Big reason why we were seeing this whole liquidity sell-off allegedly was hedge funds and institutions getting margin called on some stuff. So my main question is how does it get worse from here? So one way it got worse is China's fighting back, and someone in the comments says that China is going to fight until the end on tariffs. Um, we'll see. I understand, China has some cards, but I don't think they have all the cards that they need. As when I'm looking as a long-term investor, so let's talk about long-term damage. So I think we've already entered a recession. So you make a good point that it's not just people who didn't vote for Trump that are pushing a pause on business investment, but it's also people who don't agree with these policies or don't understand it or don't like how they roll it out. So those people, it may have hit the pause button as well. In general, a lot of small business owners tend to vote Republican or conservative, but I think these are uncharted waters. But so I think we're in recession already. I think we'll come out of it okay. The recession we had for COVID, it didn't seem that bad. Maybe part of it is because Tesla investors made a lot of money in 2020, so they're like, what? And the S&P 500, I believe, was up something like 26% or something like that in 2020. So I don't think there'll be lasting damage, even if there's issues with the supply chain. Now, we need to start getting some clarity soon. We can't have big question marks around supply chain and global shipments for a super long time. What's your opinion on lasting, damage beyond like a COVID type recession?
I think it all comes down to timing, honestly. If we have an off ramp in the next couple of weeks where, even if it is just some like watered down version of what they presented, I think the market could be fine with that. But I think what, small business owners or large business owners can have is uncertainty. And I think we've talked about this in past weeks where, if you're making a buy versus build decision as a U.S. company, like a decision maker, and you're not sure how real these tariffs are, that the prudent decision is to do nothing, and so that gets to the delayed GDP growth that you talked about. So like, I think if we have an off ramp, I think it's kind of off to the races pretty quickly here. But I think if this just drags out and if we commit to this, I would say kind of beyond June timeframe is what I'm thinking about. We've got that very serious refinancing that we need to do. I was skeptical before of the Trump is trying to just crash the interest rates so that we can refinance the debt, but he actually retweeted that video about that. So maybe he is actually trying to do that, which has some logic to it. So but if we get to that point and they refinance the debt and then there's no movement on this at that point, then I think you'd be worried about a much more serious recession and like supply chain issues, because even I think a couple months, 2 months, 2.5 months of delayed investment decision, that's going to take a long time to kind of ripple through the economy, and I think it would have somewhat serious repercussions. But I think we could kind of handle it and recoup it fairly quickly. But if it's more pronounced than that, if it drags on for 2 quarters, I think that could be a real kind of structural issue where this could be looked at as just like a very serious own goal a couple of years from now. So yeah, I think we've got plenty of opportunity for an off ramp. I guess the thing that concerns me a little bit is
I guess you could also have some clarity. I think what people need is like some clarity even while the negotiations going on. I think maybe that would help. So I think if you get some clarity along the way, it doesn't have to be like an off ramp where that the U.S. caves, but just getting more clarity and what some of the deals would look like.
The market just hates the uncertainty. If there was clarity on this, then I think business owners would have no problem making prudent investments, whether they're here in the U.S. or at factories abroad. But just this unknowing and I mean, you saw how violently the market ripped upwards when there was this rumor of a trade deal. So I think that's the kind of situation we're in, where it's just, there's so much uncertainty, and everyone is, I think, in extreme levels of fear. To your point earlier, which I do think creates opportunities. So I don't love this chaos for the country, and as an investor, and seeing values go down so sharply. Obviously, that's not fun. But I do think it does create some opportunities. So maybe that's something we can talk about, some of the moves we've made recently.
Okay, let's do that. By the way, if you're watching now, there is a bit of an Easter egg in Matt's background, and curious if anyone could find that.
It's been there for a while. I thought somebody would have found it.
A suggestion I made to Matt a while back, so curious if you all see it. It is visible now, so not referring to the Sandy bobblehead. All right, so let's talk about some of the moves that we made. So we didn't do this for all clients. We do have most of our clients are diversified, so they're not rebellionaires. But we do have rebellionaire clients. And in the middle of February, when I first was talking about this with Randy, and I first started tweeting about this, so Tesla, we ended up trimming around 350 for some clients, 340, 350. And around the same time, we also, we also trim for diversified clients. We trimmed Tesla. And this was around the whole Model Y changeover. So we did that. And then in March, we also trimmed S&P and the Qs. Something like, I think on the Qs is like around 502. And I'm not sure what it was on the S&P. But that ended up being good. And so Monday, we did buy back Tesla prior to Monday. So, that was higher. But
still a good trim and add, but we certainly didn't completely bottom tick, the stock. And that, to be clear, that's not what we're trying to do. We don't have any, claims on abilities to be able to perfectly bottom tick and top tick. But, I think as, active portfolio managers, what we wanted to do is get heavier into cash, money markets, fixed income, when we were smelling a little danger. And now that we are at peak fear, kind of swing that pendulum the other way. So sorry, I cut you off, but you can keep going.
And at the time we did it, there were people I respected who said that this whole Model Y changeover, it's because it was mentioned on the call in one sentence on the call that it was taken into account by the market, and it wouldn't cause the stock to move lower. So I think the reduction in the forecast for the quarter as the quarter progressed, that caused the stock to go lower. Certainly some of the political stuff too, but that was part of my take on the psychology, is that it would be blamed on politics. So I was going against the grain and going against people I respect, which is hard. So I think in investing, you have to be a bit contrarian in order to make money, to make some alpha. You have to stand out even from people that you like. So let's talk about maybe what we did on Monday. So I was on Larry's show on Thursday, and he asked me about the sell-off because stocks were down like 5% on Thursday. So he has asked me about that. And I said that I expected the market to, potentially bottom Monday morning. And the reason is that I expected the sell-off to continue on Friday. And and that there would be people who wanted to sell, but wanted to think about it. And what people end up doing when they do this is they might be more analytical. So they're trying to, give themselves time to make a logical decision, but they end up stacking evidence for the emotional decision that they kind of already made.
Yep.
So we did see a bit of a low on Monday morning. Sunday night was crazy. A bunch of stocks were down 10%. Some were down 17, like Robinhood and AppLovin or whatever. I want to say McLovin when people talk about that. And there were a lot of fintech influencers who they're not really in the Tesla sphere, and they were like telling people to sell or that it was going to get much worse. But we also had Kramer come out and say that the market was going to go down another 20%, and also Bill Ackman flipped. So like 48 hours prior to him going off Sunday evening or whenever that was, he was kind of for what Trump was doing and saying, give him some time. And then he flipped and went and panicked. So we sense that negativity is extremely high. And so the course from here, and this is just from my years doing this. So I'm actually, so yesterday was actually my 20th year anniversary at Halter Ferguson Financial doing this for clients.
Congratulations.
So,
but I think that's important to point out because, you were there for the Great Recession. You were there for COVID, obviously. So you've seen these, cycles a few times, and you shared some stories with me about people reacting emotionally and basically ordering you to sell, at or near the bottom, which is just, heartbreaking. But if you had essentially just managed the portfolio prudently and all the more if you had gone a little heavier into bonds and fixed income ahead of time, and then therefore had some dry powder to deploy back into equities when they're at relative low valuations, like that's the best situation that you can be in. But it's obviously hard to do that. I mean, I'll admit to being at this point, with all the volatility I've experienced with Tesla and my own personal portfolio and managing client funds and everything, I feel like I've seen a lot, and I'm somewhat hurting, like numb, or it's probably not a good thing.
Traumatized.
But, traumatized deeply to my core, I think. But it's I'm definitely feeling it right now because it's like we're in the midst of this, essentially calling a shot by going a little heavier into equities. And that's a stressful situation to be in, because you might initially be on the wrong side of that, maybe for a week, maybe for a month, and then you're looking bad. You're essentially accelerating some underperformance for a period of time when you make that call. Yeah. But our hope and what I believe is that it's the right thing to do anyways. And I think one of the so that a year, 5 years from now, clients will be looking back at how we essentially bought during these times, and I think that's going to be something that we'll feel pretty happy about, even though we might be on the wrong side of that for some period of time on the short term. But this is this is one thing that I really learned from you. I think I've picked up and internalized more than almost anything else is, in order for things to get worse from here, like things have to get worse from here. So we can imagine a scenario where that happens. Obviously, I laid out some of that at the beginning of this conversation. But I tend to think of things in probabilities, and I think it's not likely that we'll just remain bullheaded on all of this, and markets just we involuntarily, or I guess voluntarily walk into a more significant recession, supply chain shock than is necessary. So I do believe that with where valuations are right now, it was the prudent decision. So I think going into equities in general makes sense. But the other thing that I've been a little salivating over is like relative valuations.
Mhm.
Like there are some companies that have just been absolutely whacked that are like, I think actually like very well insulated from a lot of this. I don't want to share every company I'm thinking of right now, but
Mhm.
I mean, if you just look at your whatever your like Yahoo Finance or whatever app you're looking at all the different tickers, everything across the board is going down, and then high beta stocks in particular are going down even more. But there's a lot of companies that are high beta stocks, but really shouldn't be because of their fundamentals or because of how insulated they are from tariffs or from the economy in general. So I think that creates some real interesting opportunities. So in addition to just going heavier into equities in general, we've also been adjusting some weights within our individual stocks, and I'm pretty excited about seeing some of those pan out, because I think over time, like overusing a phrase that everyone's heard 1,000 times, but in the long term, the market is a weighing machine, and there are some really great companies that are down deep into double-digit territory right now, and I think that doesn't make sense in a lot of situations.
Yeah, so let's talk about an obvious one that's pretty insulated, and that's Tesla, because of their vertical integration, their localization with each major plant they have. So they should do a great job of riding out the tariffs, and I believe we'll get stronger through this.
Now, I'm not so sure about that, because I heard this guy, Peter Navarro, and he was telling me that Tesla's engines, which are batteries, are actually made, I forget where he said, but overseas, and we really need to bring that back to Ohio.
Mhm.
And their transmissions really need to be made here too. So I think that's a really solid point if you don't know what the hell you're talking about. We had a conversation earlier today, Bradford, and I would like to add to that argument that really all the oil that goes into a Tesla should really be extracted from Texas. So that's a change I'd like to see also.
Yeah. We need to do that.
On a more serious note, though, like the fact that that guy is in a position of advising Trump on tariffs and trade policy in general, like that's pretty disappointing. That like you just like go on national TV and just like literally just like talk out your ass about stuff you clearly have no idea what you're talking about, but you're trying to make an impassioned point about unfair trade practices. It just, that doesn't give me a lot of warm fuzzies that the best and brightest are advising Trump right now.
Yeah, China's very important to Peter Navarro, or Peter Retardo. China's very important to him. He's not aware of how Tesla makes their cars, or even what's in them. It's really crazy. I do want to speak for a second on how things could get worse from here. So, what could get scarier? So we could have other nations other than China that are fighting back against the tariffs. That could be one. Maybe Mexico and Canada ratchet things up. The trade with Mexico and Canada are meaningful, like with China as well, but a lot of it's one way, where it's stuff flowing into the U.S. I live near Indianapolis, Indiana, and they used to have a factory for Carrier, which makes HVAC equipment, so air conditioning, other things. And there was a time, and I don't know if this was around like 10 years ago or something like that, where they moved the factory to Mexico. But before they did that, the American workers literally had to train the Mexican workers how to do their job.
Wow.
And then they just straight up closed the whole factory near Indianapolis, Indiana. Ridiculous. Crazy. And I would say a word that's appropriate for that, it would be close to rape. That's like how violated, like you're literally training someone to take your job. It's crazy. So those are two things that could get worse, where Mexico or Canada or both could ratchet it up, or you have like some big bank go down because of currencies or something like that. But otherwise, I don't feel like it could get worse from here.
Yeah, I guess that's the question. I mean, it's almost like we're talking out of both parts of our mouth right here, because we really don't know how this is going to go down. But on the one hand, we're putting our money where our mouth is, in the sense that we are going heavier into equities. So that's really our baseline assumption, is that we went lighter into equities intentionally a couple months ago, and now we think with the significant drawdown that we've had in such a short period of time, it's prudent to increase that. But obviously, with where we are right now, with the insane drop over just the last 6 days that we've seen, nobody knows exactly what's going to happen from here. So of course, if everyone felt perfectly confident that buying right now is the right opportunity, everyone would be doing it. But the fact that that's not the case, I think it's going to be obvious in retrospect whether we're right or wrong. But I think it's you have to be willing to stick your neck out there when you're managing somebody's investments, and to make these decisions that are hard, and essentially fighting against the emotions. Because I mean, I'm sure people can pick up on it. You and I are having some emotions, about how difficult this is right now. I don't know if you have emotions actually, but to the extent you do, Bradford,
I have anger.
But so it's hard, in the moment, and I'm hopeful that in a couple weeks, couple months, we'll be able to pull out a victory lap on this one. But in the heat of the moment, so much uncertainty right now. It's very easy to see a bunch of different paths where things get better and where they go worse. But that's why we're able to have an entry point that's as low as it is right now, because the market is already, I would argue, pricing in a lot of the negative outcomes that could come to pass. So that's what gives me a little bit more comfort, is just that the market has taken such a significant beating already, that I think that time will prove that this is a good time to be buying back in, even if it isn't the absolute bottom.
So I think the market has priced in recession.
Yeah, I would agree with that.
But where I could be wrong is, maybe it goes lower when it gets confirmed, or when you hear about some factories, having to pause. That's where potentially it could go lower, where even though it's known, or I don't think it's known uniformly yet, but I think the percentage of recession is high now. Having it actually happen, there could be a reaction to that. Yeah. We do have some clients coming out and tying our hands a bit. So we have a decent amount of cash. We put a good chunk of it to work, but there's clients that have reached out and said, "Oh, don't put any more in the market. I want you to leave that in cash." Now that's been at a small scale. And I was on the offense Friday. So not only did we do a video for our channel on YouTube that was public, but we also had a private video for both our diversified clients and also our Rebellionaire clients. So we had a couple clients reach out before that video that were a bit panicky too. So that's a bit of a contrarian indicator, which means like we're probably close to a bottom where they're wanting to do something like to sell at a low.
Yeah. And one thing I should add too, like, this is not investment advice. We're kind of open sourcing our own thoughts here a little bit. If you'll notice, we're not being specific with dollar amounts or anything like that. We're kind of talking in general. Every client is different. Every investor is different and has different risk tolerances. So we can't give advice for regulatory reasons, but we also can't give advice because we don't know your individual investment situation. So that's our thoughts kind of generically on this. But maybe let's turn our attention to Tesla a little bit. I think I had a bit of a spicy take this week. I called the Cybertruck a flop, a commercial flop, I should clarify, because I actually love the car. But you and I think several others came back and said that's a bad take. So let me lay out my case as to why I think it actually is a commercial flop, and kind of curious to hear. So Elon, back when this was announced, had 500,000 reservations, and everyone was talking about, okay, is this going to sell 100,000 a year? Is it going to sell 500,000 a year? Everyone was trying to figure out kind of where the range was. I don't think anybody was thinking 40,000 a year. But if you look at the current, rough production levels, they're well below their stated capacity of 125,000 units. And to me, it seems very clear that that's not a demand issue because there's so much inventory everywhere. So at the current price point, at least, there is nowhere near enough demand to satisfy the 125,000. We can get into reasons why that might be. I mean, I think that the design is very striking. I think the political protests might make that, at least at this particular moment in time, a bit a lot of people just don't want to have the discomfort of going out in something that's so brash and so attention getting. I mean, I would certainly count myself in that category. I love the car, but I don't know that I can handle it as a daily driver just because I'm not an attention magnet. And I don't really, love the association with that. A lot of folks just like to wear Ann Taylor. It's just generic kind of stuff. And I feel like with cars, it's very much the same way. So even though I think it's a great car, and I think they've learned a lot technically that's going to go into future versions of vehicles, to me, it doesn't seem credible to say that the Cybertruck has been commercially successful. But what's your take? Why do you think that's a bad take?
Well, I don't think we know yet. So you're calling it a flop, which means it definitely went bad or is bad. And I'm not sure if it's a supply issue. So after the fourth quarter call that happened in January, Elon was talking about being supply constrained on battery packs. And we don't know anything more than that because no analyst asked about it, nor did they clarify after that. We have heard recently that potentially they figured out 4680, and the head of 4680 is looking forward to scaling it and is claiming they figured that out. So I think there might have been a battery supply issue. I also think Tesla may have been reluctant to suddenly drop the price by a big amount. So they had just dropped from 100,000 to 80,000 in Q3, and then so if they were to suddenly drop from 80,000 to 60,000, they might have been worried that it would have upset a bunch of customers. So that's kind of where my head is with it.
So I guess I'd have a little bit more sympathy for that view if there wasn't so much inventory outstanding right now. But you can get a new Cybertruck in 1 to 3 weeks, and you can actually look on the existing inventory, and there are lots of them. There's actually a website that does inventory tracking. I'm blanking on the name of it right now, but you can see actually it's been rising for Cybertruck for listed inventory on the Tesla website. So if it was just a supply issue, that wouldn't be what I would be expecting to see. Now, maybe where I could say I might be wrong is if there is a supply issue that's making their costs very high or something like that. So maybe there's some price decrease that a future production change can enable that would allow them to drop the price by $20,000 or something like that. I think if they can drop the price that significantly, then there'd be a very good chance that we'd have significantly higher sales. But for right now, it seems like they've learned a lot of stuff technically on it, but seems like it's a product that is not going to be contributing meaningfully to the bottom line in the near future. Now, that said, I also think it doesn't matter too much. Like, of course, it would be better if it was, doing 30,000 sales a quarter or something like that. But really, even if it was, that wouldn't significantly change the company's earnings profile. What really matters is autonomy, and that just still seems like it's so under the radar for so many people. Like, it's when we're feeling the fear and the uncertainty and the panic in the markets, like one thing that I just kind of keep coming back to, which makes me feel comfortable about remaining concentrated in Tesla personally, is that like nobody knows that FSD exists right now. People have such a skewed version of how good it is. Maybe
they'll say, "Oh, my Mercedes can do that."
Yeah. So like I'm really hopeful that Tesla does some, I don't know, serious advertising or some way, by hook or by crook, like that people just figure it out. My sense is when robotaxis go live in Austin in June, that's that moment where people will be like, oh, you can actually get the same software, like almost exactly the same on just a personal driver car, and you can experience that. That I think really will be a game changer. And I think it stands to reason that take rates will increase significantly. That'll flow to the bottom line. Then you got this whole robo-taxi business model that I think really will be a structural change to the company's profitability in like 2 years at most. So I get back to that and how it feels like we have inside information a little bit because we drive these cars every day, or rather the cars drive us. It is so good. It's just
And we're talking about hardware 4 cars. That version is even better than hardware 3. Some people have good luck with their hardware 3, but toward the end, when I turned in my hardware 3 Model Y, it wasn't very good. It's very hesitant. It was safe, but it was overly hesitant to the point where it's just very frustrating. And I think you had a similar experience too, Matt.
Yeah. I mean, same thing. It increased your overall stress level to drive, even though like most of the time it would do things really well. But then like that one time where it makes a bad mistake or just like does something in an extremely awkward way, it's like, so like the overall stress level increases. I was actually on the phone with you today, Bradford, when I was being driven in my car, and this guy in front of me kind of like slammed on his brakes fairly aggressively because he almost missed his turn. Mm-hmm. And the experience of having that on FSD where I didn't have to slam on my brakes, it was just like, oh, we're braking pretty aggressively right now. Okay. Like it actually alleviates a lot of the stress of driving, where I was saying this was kind of a revelation to me today. A lot of driving is just a series of negative emotions because like somebody cuts you off or does something stupid. And so like you just get annoyed, and then like you've got to like handle that situation, and like you get like angry at that person. But in my situation today where I would have normally like, blood pressure rises, I get a little angry at that guy. Instead, it was just like, oh, like this is happening, but like it doesn't feel like it's happening to me. It just feels like a situation that is happening in my environment around me. If that makes any sense. So I don't have the responsibility to brake to avoid an accident, and the stress of knowing that if I didn't do that, then I would get in an accident, and that would be like very stressful and anxiety inducing. So that like the fact that FSD just handles all these things flawlessly, without you needing to worry that it, whether it will or it won't. And of course you have to be paying attention. It's not like I didn't notice the guy in front of me was stopping, but the car, I think it decelerated more quickly than I probably would have at first. So if I was in charge, I would have like braked, and then really slammed on the brake toward the end, which increases the probability of an accident, and then gets me angry. So it's just, it is such a game changer that I think most people have no idea that this technology is even out there. So I'm very much looking forward to more people understanding that, and understanding that Teslas don't have transmission and that batteries are not an engine.
I'm curious how the public finds out about it. Maybe they'll find out about it through the whole robotaxi thing going wide. But initially it sounds like Tesla, it's going to go to Tesla employees around Austin, and I'm guessing they'll be pretty quiet about it. I think people will go to Austin to try to get robotaxi rides, but it may just be limited to Tesla employees. So I'm curious about when that changes. Maybe once they go to Dallas or other cities, or maybe there's a certain point where they begin to grow up beyond just their employees at Giga Texas. There are 22,000 employees, and most people use ride shares to go to or from work. So definitely would be high usage for those people in that area. So there's been some questions about Lemonade. Let's talk a little Lemonade.
Ooh, all right. Yeah, so Lemonade is down about 50% off the highs from late last year. I think it was. I think it peaked around $53. I didn't see where it closed today, but somewhere around 25, 26, I think something like that. Yeah, 25.12. Down 10.6% today. So we don't really have any new information on Lemonade. I think one of the things I've liked about Lemonade is just that it's a very steady, just kind of like quarter by quarter. They add a good number of new, highly valuable customers when you're looking at the entire lifespan of their customers. And as they continue to grow, eventually they're going to reach this critical mass where, you know, the gross margin from all these customers, which is becoming extremely predictable. That was a concern in the past. I would say it's very clearly not today. But the gross margin, or what's left after paying out all the claims, eventually in about 2 years, that's going to get to the point where it's enough to cover the fixed costs. And then after that, it's just going to continue to grow. And then it'll be like all that basically drops to the bottom line, all that incremental growth, because their fixed costs are extremely fixed relative to other customers because of what they're doing with AI. So Lemonade is kind of interesting to me because it's so volatile. I mean, it has a beta of, I think it's like 2 or maybe a little bit north of there. Let me just see what Yahoo Finance says. 2.13 is saying is the beta. And for those who aren't finance nerds like us, it just means if the overall market drops by 10%, then Lemonade will drop 21.3%. So it's basically a measure of how correlated to the returns of the broader market is a stock. So Lemonade will move in a very significant multiple of the underlying indices. But what's interesting to me is like Lemonade is very isolated from tariffs. I mean, it's for the most part a U.S. company, although they do have some insurance products in Europe. It's not like they're importing products. They've got their customers and their claims are going to be in the geography where they're operating. They've got a little bit of auto exposure, and they're trying to grow that. But even if auto prices or repair prices really go through the roof, they've managed that before, and I don't think that would be a catastrophic risk for them. So, I'm looking at the company right now, and I'm looking at how significantly they've been hit, when really I think they're one of the most insulated companies possible from this, given the fact that they're in insurance. Like everybody's going to still need insurance, and their underlying AI is still performing as well as to be expected. So, this is a story that I like. I'm happy to just kind of hold this company for the long term, because I think this is just going to take some time to play out. And when we're still at this phase where we're 2 years away from GAAP profitability, it's understandable to me that this is going to be a narrative stock where it's very easy to say, look, they're just losing money every single quarter, and even though they're growing revenue, like their losses are actually increasing. Okay, that was actually because they were increasing their marketing spend, but like, if you're not interested in the nuance and in the details, it's very easy to kind of paper over that level of detail. So this is a company that is just very consistently executing. They're doing exactly what they say they're going to do, and just quarter to quarter, it's like, you're validating our own model that we've built that has been very predictive of their quarterly results. So we do
owe everybody a bit of an update on Lemonade, and response to like some recent criticism from ex insurance industry veterans who kind of looking at it how a Wall Street analyst would, or how a legacy insurance person would look at it, where every insurance company must spend money to acquire new customers. They don't just come out of nowhere. They have to spend money, whether it's on advertising or on agent commissions or any other means. They have to get customers that way. And when that happens, you outlay that money in the current quarter, but then over time, you accrue value from that customer over time. So we'll look to clarify that over time and add some more. We did notice that there was a Tesla insurance customer in Arizona who is paying Tesla $400 a month, and Lemonade was trying to poach them, saying, "Hey, if you move to us, it'll be $200 a month."
That's pretty interesting.
It's pretty shocking.
It really is. I mean, I think the simple analogy about the point of you have to pay for that cost up front. If you imagine Tesla, every time they had to invest $6 billion on capex, or like I think in a quarterly rate it's more like 3 or 4. Imagine if Tesla had to have that all as an expense on their income statement rather than as like a capital expenditure, which goes onto the balance sheet and then depreciates over time. If you were to take that huge capital,
if you had to totally depreciate it in the first quarter,
in the quarter where you're building it, and so like all the new superchargers you're building, all the new mega factories, all the new assembly lines, and all the tooling equipment, like every single thing that Tesla's building out, if that just hit the income statement line, like Tesla's financials, their earnings per share would look terrible. But that's essentially analogous to what Lemonade has to do, because they have to pay for all their customers that they're acquiring up front. They fully depreciate that hit, but then they get the huge benefit of those cash flows on the back end. And it's even a bigger benefit than other insurance companies because they're not paying commissions to agents. Most insurance companies will pay a commission to an agent in perpetuity for the agent that actually brought that customer into the insurance company. So like the back end financials, if you like fully understand that and model out these customers by individual cohorts, as we've done, which nobody else is doing, it's like very important, I think, to actually model it out in that level of detail. But once you actually do that and you project forward a couple of years, it's extremely compelling how much cash flow they'll be generating and how high their earnings will be. They're already cash flow positive, which our model did predict. So it's a company that is just executing really well. There was a comment in here I want to call up, like, Lemonade is boring. Yes, it is. But and Bradford, you're muted.
It's also a little bit complicated too, which makes it hard for investors.
Yeah, but
go ahead.
There's no optimist, like there's no FSD. There really is nothing super sexy about this company. But what is sexy, at least to a finance nerd like me, is when you can project forward and look at what the earnings and the cash flow are going to look like, and you kind of compare that to what Wall Street is thinking, and what, like, when we're talking to analysts about how they view the stock, and they're talking about like multiples of book equity and these other metrics that make sense for legacy insurance, but just don't for Lemonade, at least at this stage of their life. So what I think is not boring is the alpha potential that I believe is there for this company. And I would also say what's not boring is having a stock like that in your portfolio. So when it really goes on a tear, as it did last year, we were able to pretty successfully trim that back. It outperformed Tesla even last year in the fourth quarter by a pretty significant margin. So you're able to kind of take those gains, trim it back. We did a very aggressive trim on Lemonade, pretty near the peak, and being able to plow that into other names. And then now that it's dropping to the $25 range, like, I'm just salivating because nothing about the company has changed. It's just the market is yelling a different price today, but we still think the fundamentals are, like, I would say, completely unchanged. We maybe took our bull case down slightly because they seem to be rolling out car a little bit more slowly than our model had initially been projecting. But all the fundamentals are almost exactly the same, and the valuation that we're coming up with is mostly unchanged. So this is a company that I think remains significantly misunderstood, and I'm very excited about their future, even though it's admittedly it is a boring product in a boring industry. I think they're doing stuff that is not widely recognized or appreciated.
Yep. So I want to feed the good wolf. Do you know what feeding the good wolf means, Matt?
Does that mean bringing it back from extinction and creating a dire wolf? Is that?
I forgot about that. That's a good one. So there's like feeding the bad wolf, which is like the negativity, the war, and then there's the good wolf, which is the positivity and the peace, right? So there's like it's a ancient First Nations type of wisdom of you know, feeding the positivity and the peaceful side. I think when people are this fearful, you want to endeavor as an investor to try to do the opposite of what everyone's doing, and it's really hard to hang in there, and catching a falling knife that doesn't tickle.
No.
Does not tickle. But if you look out 5 years from now, you imagine where things will be. Trump will not have destroyed the global economy. That's not going to happen. COVID didn't destroy us. If we have a supply chain shock like COVID and a recession like COVID, it's not going to destroy us. I don't think we'll have the types of layoffs that we had with COVID. We won't have that type of unemployment.
Probably not that kind of QE either, though, on the back end of it, and that injection of liquidity.
Yeah.
But I'm feeding the bad wolf now. I'm sorry. You were feeding the good wolf. Let me not interrupt you.
So what I want to share with you all is that this crisis will pass. We'll be on the other side of it. We have AI automating our business, lowering our costs, making it easier for us to make decisions, making us more efficient. Matt and I have seen a lot of manual workflows over the last couple of days. Some
gosh.
of them automated, but some
Shocked
of them
I still
not
have any hair.
automated. So, we know what it'll look like to be more automated from here. So there's some low-hanging fruit that we're hiring for. Talked with some rock star candidates, so really excited about doing those second round interviews soon. So we'll be on the other side of that with all companies, where all companies that are serious about automation, getting more efficient, more productive, and delivering more value to customers are going to do that. They're going to lean heavily on that. And I think life is going to look very different. I think in the business world is going to start to freak out like 2 years from here, tops, just from the amount of like automation and business process. I think that's going to be solved from here. What's your take on that AI optimism, Matt?
Yeah, I think I wouldn't say an AI maxi because I'm not, but I'm definitely close to it. I just think it's moving so fast, and we were just talking about how most people don't appreciate how good FSD is right now. I mean, that's just one example of an AI integration that's going to change the world. There are so many of them, and I think we're like in 1995 trying to imagine what the future of the internet is going to look like. We can't even imagine. But what I do know is that companies are very serious about this AI race. It is significantly increasing the amount that we're able to do already, and the rate at which these improvements are coming is only accelerating. So my sense is, even if we do have some pretty serious concerns in the short term, I would not want to miss the bull market that comes from AI just changing the global economy. I really do believe it is going to drastically change the entire economy. I think it's going to be hugely deflationary. I think it's going to be hugely additive to GDP. And this like future of abundance that Elon talks about, I very much believe in that. So, how much of that makes its way into the public consciousness and into investing returns and reported earnings per share for companies in the next, 12 months, 24 months, I'm not sure, but I definitely don't want to risk losing out on that, because I think it's going to be, I actually think it's going to be historic in terms of like investors who were actually able to participate in the upside that the AI market's going to bring. I'm talking like a little, I try to be very like middle of the road a lot of times, but I think this AI thing is extremely real. And I think panicking over tariffs when we're on the verge of like an absolute upheaval of the world economic order because of what AI is going to bring, I'd much rather put my chips on maybe a little early to make sure I've got exposure to that theme than trying to, keep it a little extra cash on the table in case, tariffs get worse from here. So yeah. I'm a techno-optimist, and I think it's going to like rewrite a lot of the heuristics and the rules of the road that we take for granted in investing. So I'm very excited. So yeah, definitely feeding that good wolf a good T-bone here.
Now, we're not claiming that suddenly there's going to be a billion Optimus humanoid robots that can totally handle a refactoring of the global trade order, but that this technology, AI and business bare minimum, is going to begin to reshape the world rapidly within 2 years, is my call. And we could see humanoid robots coming on soon thereafter. So we're big believers on this. We'll be sharing more about this in the future. And with that, he's Matt Smith from Rebellionaire.com. I'm Bradford Ferguson, and bye for now.
Bye for now.